Ladies and gentlemen, welcome into yet another live sort of thing we got going on. This time we got Nick and Nate. Their Twitters are linked in the description here. Today's topic, we are supposed to be kind of talking a little bit more on the Uber thesis. Off camera, I was kind of talking to Nick halfway through the conversation. We're like, okay, well, you know what? This would be much better if we kind of put it on a live format. And I think a lot of people would kind of benefit a lot. Part of the Uber thesis is I'm so far deep into the research that some of like the layman questions and stuff like that. I'm starting to not like miss them per se, but more so like there's a lot of stuff to cover. It's good to have Nick and Nate on here to kind of ask the layman questions is what I'm trying to say.
I'll be there to ask the layman questions because I'm not into the weeds as much as you guys are.
Yeah, for sure. If you guys wanted to give maybe like a 2-3 minute quick intro to the people maybe not familiar with your content, and we'll get us started.
Hey everyone, I'm Nate, or I guess Endicott Invest is my channel and handle on X. Been investing for 7-8 years. The classic story is my biggest winner, my early winner was Palantir. I don't like to go around talking about it because I feel like people abuse the heck out of it. But yeah, I've been investing for a while. Super big on a concentrated portfolio, so big on Nebius and a few other names. Excited to be here, and I think it's fun. So appreciate you having me on.
Over to me. Okay. My name's Nick. Many of you probably know me by Wealthmatica or Mr. Zeta. Some people call me. I'm big on Zeta. I started investing, it must have been just around COVID. I really just hopped into a couple of ETFs. I didn't take stock picking seriously until about 2022 when we had that big down market with the stagflation. My biggest win would have been Meta. My biggest miss would have been Palantir. I never got into it. I just kept saying, oh, the valuation is too steep. It's too steep, too steep. So I'm never making that mistake again. Hence why I'm so bullish on Zeta right now. I'm not saying that they're, the same company or anything like that. It's just when I see a good opportunity, I'm going to take it. That's pretty much all I got. I'm here to hear this Uber thesis. Arya, back to you.
Yeah, for sure. So I was having a bit of trouble, like where we kind of start the conversation. Obviously everybody's like familiar with the Uber business, but I think it'd be helpful to kind of, I don't know, Nate, I mean, if you want us to kind of start us off of like, like what do you maybe think of like the AV landscape? What do you even just think about of the business in general? Maybe if you wanted to kind of start there.
Yeah, when I invest, I'm really big on just like the value prop of the product. Like I love product-focused companies and customer-centric companies like an Uber. And so I've always liked them as a product. Obviously, I feel like everyone under the age of 40 has used Uber at least once in their life. And I use it anytime I travel for work, anytime I travel internationally. Besides Grab in Thailand. But I use Uber all the time. And so I love the product, love the name. I think for me, I don't pay much attention to it because I just feel like I don't know where. I guess longer term, I like companies with operational leverage. Not that Uber doesn't have it, but I just see it as such a large company in terms of, like you got to pay out the drivers, and I don't know where the leverage comes from besides increasing prices. And so I'm just not educated on the name in terms of what they're doing. But I know they're a great company, great product, led by a great. He's founder, right, Dario?
No, actually, he's not. He came in, I want to say 2017, 2018.
Okay, I just know he's a really good leader. And so I there's a lot that appeals to me. But I'm just kind of uneducated on the fundamentals and like the numbers and what they're doing.
Yeah, for sure. So I mean, in terms of the operating leverage, and they actually don't increase prices. So it's sort of like it's like a supply demand dynamic of like, like when you open the phone, like if you ever take the same trip, but like at different hours of the day or different times of the week, you'll notice like sometimes a trip that I take pretty regularly, like sometimes it costs $11 and I've seen it as expensive as $16. That's not Uber adjusting. Like they give you parameters in terms of how much a sort of trip could cost, but they don't necessarily
Sorry to cut you off. Is it not like an algorithm to where like at some point, obviously there's parameters now, but if they adjust the parameters 10% in a different direction, then I feel like that is subliminally increasing prices. I just don't know how that works. But yeah, you're funny because like my buddy traveled from JFK home one time during the holidays, like $200 Uber versus I did it and it was like $55.
So that's purely based off of like at the time there probably wasn't that many drivers in the area there. That's why it costs a lot more than if you were to do it at a different time. If you ever go to like a concert or like a sporting event, you'll also kind of notice that where it's like a typical Uber from like, let's just say from the center of the city to the suburbs or something like that should regularly cost about $50. If there's a Taylor Swift concert that night and there's hundreds of people getting an Uber back, it's going to cost a lot more. And it's kind of dependent on like the person next to you willing to pay a higher price. Just classic supply and demand on that front. So yes, structurally though, like, I mean, this is a business. I was telling Nick about this of like, this is a bit of a dated stat, but like over the past 3 years, they've grown their headcount by like 2%. Revenues have doubled in the same time frame. So it's like, they have that inherent sort of operating leverage built into the business of like, now that they are structurally profitable, they don't need to, hire more engineers. They don't need to hire more customer service employees, whatever the case is. They're able to continuously kind of like scale up and do more rides. And obviously those rides are being done profitably. So they have that sort of inherent operating leverage. Another question you had was like, where's the growth coming from?
Yeah, I guess it's just obviously I know they have a massive. I know the TAM's big, but I know they've also addressed most of that market or a lot of that market. And I mean, they have a crazy moat. Like I don't really Lyft. I only ever pull up Lyft if I want to maybe get a cheaper ride, but I always primarily use Uber. And so there's really not much out there besides Uber, at least in the Midwest. Obviously, when Tesla and Waymo try and get out here, we'll see. But yeah, I guess I'm curious on where the growth can come from moving forward. Obviously, I think we talked about a little bit that international is sort of the next leg, but maybe there's more, domestically in the U.S. as well, North America.
So I think I pulled this up on the last stream, and I'm trying to find it as I talk here. But if you guys were to guess, like, it's a bit of a weird stat, but like, most people kind of think of it as like, oh, I use Uber. Everybody I know uses Uber. So like, where is the sort of incremental growth in a market such as a Canada, US, or like these developed markets coming from? And you'd be surprised, dude. But I think if I recall correctly, it's like only 20% of adults use Uber every month in the US. So that is still like huge white space in terms of being able to like turn the remaining 80%, I'm not saying all of the 80%, but the remaining 80% of adults into like frequent, sort of like monthly customers. And then you'd also be surprised, like internationally, there's huge sort of like G7 countries. I think Germany is like the main one, where the penetration of Uber in Germany is just very low. It's like 1%. So they still have like huge sort of white space to be able to kind of grow. And then on top of that, like even if you get an Uber customer to use them once per month, who's there to say that like the frequency thing could also be a different growth path for them as well? So the average Uber user uses Uber 6 times per month, and like they're going to drive that frequency up over time.
Yeah. So I guess a couple questions there. First, what is the growth rate of that penetration? Like, has it been sort of flatlining from like 18.5% to 19.5 to 20, or is it sort of incrementally moving pretty quickly? Because I do think like, yes, they have 20% penetration, but kind of like you said, like I think that's just, I don't think, and it's just anecdotally, I don't think that's going to change much based on just habits of humans. Like if you don't use Uber now, I just don't see what changes in your life to make you use Uber later. Maybe it's a generation thing where like anyone over the age of 50 just doesn't even want to use Uber, whereas the newer generations will continue to use Uber, and that's where their penetration comes in. But I feel like anyone in the working class under the age of 50 has used Uber, and so I just don't see it changing, increasing, in my opinion.
Like the penetration itself?
Yeah, like maybe it'll get to, if it's at 20 now, maybe it gets a few more percentage points, but I just don't see it being they get up to 35% in the next 5 years, or something of that nature.
I think they've actually, so on, I want to say Q4 earnings call, they were talking about delivery specifically, but delivery's penetration is lower. So that's at like, I think 15%, like broadly speaking. They're talking about how like e-commerce penetration as a percentage of total commerce or like total retail is like 25%. And they were kind of targeting, like a number north of 30% longer term with delivery specifically. I don't know too much about mobility, but yeah, you would imagine like, most of these markets do kind of incrementally move higher. I would disagree with you in terms of like, it doesn't, go north of 20%. I think, it probably does go north of 20%. And you also have to imagine another number they kind of gave us was like their annual active base is 450 million users. Their monthly active base is 200. So like these two numbers should kind of get closer together over time as people use Uber and Uber Eats in higher figures just naturally off of the growth of the business, right?
Yeah,
so
I think it'll be over 20% for sure.
In most markets.
I just don't see it really growing much. Like I guess Uber's been a product or service for what, 15 years now. I just don't see it penetrating much more than it already has, at least in the US. Like anyone, I guess it's more of an anecdotal age thing. Where like anyone I know over the any between 18 to 50 uses Uber when they need it, but they're not going to use it any more than they already do. And so I just don't know where the growth comes from there. Obviously, as people age, once we get another 10, 15 years, it'll hit all demographics. I'm actually probably more bullish on, which is probably a lower take rate, but their delivery side. I think
Oh.
humans are just getting lazier and fatter. And so that's something that I think I think there's lots of TAM there.
It's a strong thesis.
Very strong thesis. Natural secular tailwind of humans being lazy. Yeah, it's a good one, man.
I mean, literally.
I'm reading here that management's target, they said that some of their best-in-class cities are New York, Rio de Janeiro, and Mexico City, which also have what they've quoted as untapped potential. They've guided for a global average between 20 to 40%. Right now, the current global average is about 10%.
Right. Yeah, and some of their top cities here, I've pulled this up. This is from the 2024 like investor slide deck, but this is 2023 data, so it's pretty dated. Like we'll get an update on this. Should be this year or the year after that, I think. So they only give this like every 3 years, right? And at the time, Australia was their best country, so that was roughly 20% penetration, followed by Brazil. Funny enough, then UK, then Canada, and US is actually the fifth market. At the time, it was 10%. I think it's a little bit higher now. But yeah, so I mean, like in terms of future growth, you kind of have these like two vectors of, bringing on more monthly active users, and then in addition to that, with your monthly active users, getting them to transact in higher frequency. So the growth, I don't have growth of like, the penetration per se.
Yep.
You could look at monthly active users, that's growing at about 20%, like for the entire business. Frequency in of itself is growing about 4% as well. So you have these sort of like two things. And in terms of like, like anecdotally, I also like literally every single one of my friends and every person I know uses Uber pretty frequently. But dude, like you'd be surprised, right? Like how long has Meta been growing at 6% and they're at like 4 billion users? You know what I mean? So like, I think these sort of tech companies kind of surprise us to the upside in terms of like just how far the user count can continue to grow. Admittedly, international markets is going to be probably lower priced and lower ticket priced rides. So that's something to grapple with as well. But I think
it's similar to Meta though. Their ads are way less from their ads and
way cheaper.
Other international.
Way cheaper.
I guess the next question I have then, I know you said they're growing 20% as a total base. What are their margins like? So, gross profit, operating profit, and net income margins.
Yeah. So gross profit margin is a bit of a weird one to look at with Uber here. It's a little bit lower, so it's like 40%. In my opinion, and like we don't have concrete numbers on this, but I feel like these are structurally higher margins if we were to take out the freight business. So they have this freight business, which I can also show you. It does about $5 billion of revenue. So this is roughly a 10% revenue segment for them. You'll notice that like basically as soon as they acquired a business in 2022, the margins fell massively. So historically,
I'm extremely uneducated. They do 50 billion in revenue?
They do 50 billion in revenue, yeah.
That. Okay.
Yeah, it's bigger than Coca-Cola, bigger than Nike.
It makes sense. I've never even really looked into them. So that's okay. Interesting.
Yeah. And they do $200 billion of gross bookings, right? Because they only keep like about 25% of the net revenue. But yeah, so margins on the core business of delivery and mobility is probably about 50%. But including that freight segment, which is probably like a 5% gross margin business, it's a garbage business. They should probably spin it off, in my opinion. Including that, it's a 40% gross margin business. And then from a operating margin perspective, I think they hit 11% recently. And so this is kind of what that looks like. They're kind of probably targeting towards, I don't know, like a 15-16% operating margin in the next handful of years. Is kind of like if you they gave us like 2026 or 2027 guidance. If you work back the adjusted EBITDA numbers, you kind of land at that 15-16% margin range. Yeah.
Got it. Interesting.
Nick, been awfully quiet there.
Yeah, no, I'm just observing. Something I wanted to note too, because I've done some research into Uber myself. I'm not completely ignorant on the company. There is some things that I'm just uncomfortable with that Ari has kind of filled in the gap, specifically around free cash flow. But something I found interesting that I want to highlight before we get into some more of the analytics on fiscal here. I believe North American penetration, like population penetration, was about 25%. So I think, Ari, you can correct me, but I think the stat is roughly 25% of the entire population in North America uses Uber at least once a month. And in Europe, the Middle East, and Africa, it's somewhere between 5 and 10%. And then Uber recently, I think it was last week, just acquired a brand new company in order to kind of bridge some of that. It's a company.
Oh, really?
Yeah, they bought a company out in Turkey, I believe. It's called Getter, something like that. Anyway, so I think the opportunity internationally is huge. So not only just in North America, but internationally is massive. I think Uber has a huge market that they could fill globally. So there's a lot of upside here, in my opinion. One thing that I'm a little confused on still, that I'm going to play a little stupid here, because I know we've talked about this already.
I've been doing.
I'd love to learn a little bit more about their free cash flow and whether or not that is an accurate representation of value. Let's just put it that way. Is this something that investors should be concerned about when they look at free cash flow? Is there any hidden fees there? Is there any sort of hidden cost structures that people should be aware of?
Yeah. So short answer, yes. Don't just look at the blank free cash flow number. Before we get to that really quickly, I'm glad you brought up the acquisition stuff, because they've been making like a huge sort of leap into Turkey in specific. So this is the second acquisition they've made. They bought like I believe like a pure sort of like e-commerce business, and then they recently bought the delivery. They bought like the DoorDash of Turkey, to my understanding. I haven't looked into it too much. I did like 5-10 minutes of research on it. But historically, what you've seen with Uber is like in markets where like they don't think they can get the Uber brand to get big, or it would cost too much, or they enter it and they realize it would cost too much to kind of get a leadership position, namely China and Southeast Asia. They end up leaving the market. And then as a part of leaving the market, they make a deal with, for example, a Grab, or they make a deal with the Chinese equivalent, which I'm blanking on the name. But they make a deal with them, and they own like a 10-20% stake in that leader within that country, and it goes on their balance sheet as an equity stake. And that's historically been really well.
They have that with Grab, right? They have that equity stake with Grab. That's
used to have a 20% or 18% stake in Grab. I think they've sold it down over the years, or been diluted down. They're still a bigger shareholder than the CEO himself. They're the biggest shareholder of Grab.
Interesting.
Yeah. And then another interesting market is sort of the Arab countries. It's called Careem, the sort of like super app of Middle East. That's way more than just eats and e-commerce and mobility. It's like, like you can literally like hire somebody to like come fix your furniture in your house, or like come do your laundry. It's like gig economy for everything. And that they own 80% of that business. They bought it for like a bargain price. I can't remember exactly, but like they bought it for like about $1 billion, I feel like, in 2020. And like it does.
How much of their business?
They own 80% of Careem.
Okay.
I could quickly Google it. How much of does Uber own? But yeah, I think they bought it. So, oh my God. Okay, so they spent $400 million to buy Careem in. Oh, this doesn't make much sense. I think they initially invested $400 million, and then they eventually bought out the whole thing as at $3.1 billion, and like it has a huge like 50-60% market share in UAE. So like Dubai, Abu Dhabi is all under that country. In terms of the free cash flows, so another interesting thing they did, and this was part of the reason as to why they've become sort of like structurally profitable, is a huge expense for Uber historically has been they buy insurance on behalf of the drivers. So every single driver, depending on what state you are within the US, for example, they have to purchase a certain amount of insurance reserves, or have a certain amount of insurance reserves if that driver gets into an accident. I believe California is like the worst of all the states. You have to have like $1 million of insurance reserves per driver. And then in some other states, it's less. It's like 200K, 250K, something in that ballpark. And so I don't know the exact year, but they basically started to kind of like they like became their own insurance company, essentially. And so that goes into the free cash flow statement. And so it kind of looks like this. This doesn't include like only the insurance, what's it called? The insurance expenses. So change in accrued insurance. Yeah. So it's about like 3.6 billion over the trailing 12 months. And so basically, if you want to value it on a free cash flow basis, which I don't recommend, you kind of have to like strip that out to be able to value it on free cash flows. Yep.
Speaking of, what's their cash position? Do they have one?
Pretty solid, if I do remember correctly.
And I guess what's their debt to cash ratio too?
So they have about $6 billion more debt than they have cash. So
Okay.
yeah, they have 7.6 billion of cash, and then you're looking at so about 12-ish billion dollars of debt total.
Got it.
Yeah.
Okay.
Pretty
you're
healthy
suggesting is
overall.
the best metric to use to sort of get a great valuation of this company would probably be what, operating cash flows? Or are you suggesting maybe operating income?
No, so operating cash flows would have the same problem, right? So if we go to the free cash flow statement here, and let's take a look. So this is the line you have to kind of look out for, the changes in accrued expenses. Under this is those insurance reserves. So actually not all of it is insurance reserves. About half of this total line is the insurance reserves. So actually a mistake on my end there. It's about 2.6 billion and it's declining. So this is something management kind of pointed out too in 2024, was like they expect that this should decline partially due to like changes in tort laws and stuff like that in California, because that's like the majority of where these insurance reserves are held. So this is kind of declining and becoming less of a problem. Another way I could sort of visualize this for you is, I should have the custom metric here. Yeah, accrued expenses as a percentage of free cash flow. So it's another way to kind of look at it. You could see like the insurance reserves as a percentage of free cash flows is consistently declining, basically.
Interesting.
Yep.
And then on a valuation basis, how
to value it? Great, great question. So you can't use PE, and I'll show you why you can't use PE either. They had this like tax thing similar to a Meta or like a Netflix. This is under provision. I believe this is a provision for income taxes. So as you can see, that looks a little bit irregular. This is a boost to net income, by the way. So if you look at net income trailing 12 months, you're like, oh, 15 PE. Oh, it's so cheap. I didn't realize this is cheap, whatever. It's not actually that cheap. It's because this provision for income tax is like artificially boosting net income. You could do it two ways. One, you could use the forward PE ratio because that doesn't include it. This is in my opinion, like a decent way to kind of look at the valuation of Uber. So about 21 times forward PE, or you can also look at their adjusted EPS. So this kind of strips out all that stuff. So if we take a look, their adjusted EPS is 2.45. So if you take the difference of those two, it's about a 29 times trailing PE and a 21 times forward PE, growing EPS like about 30%. So pretty cheap.
Yeah, it is pretty cheap right now. I won't lie. It's attractive to me. It's attractive. It's a high quality business, in my opinion.
I hear the dog in the background. Yeah. Anyways, that's sort of on the fundamental side, and then you should see sort of like operating leverage with the business over time as well. I'm not a big fan of looking at trailing margins at the moment. I feel like it's a little bit understating sort of like the peak profit potential of the business. We have a couple comments here, by the way, so can I bring these up?
Yeah, you should be able to click them. Should be something.
I should be able to click them. Okay. Yeah. Oh, no, that's not it.
One of them came up a second ago.
Have Uber one. Isn't this obvious? Okay, here we go. So maybe, unless you guys want to talk a little bit more about Uber, I'm happy to, but we could pivot a little bit towards SaaS and maybe
we can pivot. Yeah.
Loop back around. So, okay. Pied Piper asks, do you guys actually think SaaS is dead? I've been becoming more and more bullish that AI agents are going to make SaaS so much better for certain applications. Thanks. Nate, did you want to handle that one?
That's a large question. No, SaaS isn't dead. Obviously, I do think that it depends on what you're talking about. So as an example, CRM, Salesforce as a company is not dead. I do think though that certain products or maybe certain things they're building could be. For example, Agentforce. I work with Agentforce every day. It's not very good. Other agent platforms like Innate, and there's a few others I can't think of right this second, but there's a few other platforms that just do have better agents. And all it takes is a quick API connection. Now, obviously, it's not in the system of Salesforce, but I do think that, like you were saying, Pied Piper, that I think overall this agent movement we're seeing is just going to benefit the SaaS names that are critical. Now there might be, just like the dot-com bubble, there's going to be names that go to zero, but I just don't. It's few and far between. Most of the critical ones we talk about all the time, like a Salesforce, an Adobe, a CrowdStrike, all these names, ServiceNow. These are all these companies that will be here to stay, and will benefit from this move. And so the sell-off to me is insane. But I get just the general scared feeling from it. But I do think we'll look back in 2 years and be like, oh, that was hilarious. Can't believe these names dropped 40, 50% in
Yeah.
like 8 weeks.
Yeah, definitely. I mean, I think we talked about this a little bit on the last stream as well, but like, there's a great divide of there's mission critical and there's not mission critical, and now everybody's sitting on the stove, it's warming up underneath you, and there's a question mark, like, will you adapt to the new paradigm? And so ultimately, like, I would imagine most of these companies are able to pivot. Will there be casualties? Will they come through the AI revolution with a couple scratches, right? Like that can happen. If we take the sort of transition of on-prem to cloud as a historical example, which I think is a decent proxy. Obviously no two comparisons are one-to-one, but obviously the great dominant companies of that generation moving over to the cloud sort of future of the industry, like there were a lot of dominant companies, say in Oracle and IBM, SAP even, right? Like, yes, they were super dominant back then, but now there's alternatives. And I think the clearest example of this is if you look at the market share of CRM, like in 2012 and compare it to today, it was like at the time, I think IBM had like a 10-12% market share. Oracle had like a 10-12% market share. SAP had a 10-12% market share. Same thing for Salesforce. So it was like there was like 4 big dogs in the CRM market. And if you look at it today, I think like 3 of those companies aren't even on the list anymore. That's how small they've gotten. I believe Oracle's like a 5% market share, and that's it.
And the best part is too, like, people are worried about this, but SAP was still, I think, if we look back, I'm looking just on the charts. 2010, SAP is $44 a share. It's still $204 a share. So it's still 5 and 6x over the course of 10 years, and probably performed with the S&P, or maybe outperformed it a little bit since then. But again, like, even the ones that lost market share still did fine. And so I don't think we're in a market where SaaS is just going to go to zero. There might be, like Ari was saying, a couple names that do get hit, get some scratches. But then there will also, on the flip side of that, will be some names that thrive even more so because of this and kind of show their dominance even more. It's just the companies that want to take action on it. But like I said, I do think maybe certain products, certain parts get hit. Like I said, for Salesforce, like their agent force isn't the strongest. And so there could be a partnership they have with other agent orchestration platforms and stuff to have APIs. But yeah, overall, I'm bullish on the SaaS sector. And I think the Selloff is, I honestly, now I'm looking at it again, it's like ludicrous. The drop is literally stronger than the COVID-19 drop. Guys, like literally, the pandemic drop was smaller than this IGV drop. So the ETF or the index for SaaS names. This drop is worse based off of nothing. Zero news other than maybe some macro scarcity.
No, it's Claude code. It's Claude code.
Yeah, Claude's going to just take over. Yeah, it's just insanity.
It's crazy, man. And I'm talking from experience too. Like, look, I'm in an enterprise environment and we use Claude Code, but Claude Code is meant to patch the gaps between enterprise software.
Yes.
It's not replacing enterprise software. And then people, hypothesize and say, oh no, well, eventually it'll get good enough to replace it entirely. Well, perhaps maybe like a Monday.com or aspects of Wix, right? Like these sort of companies, or even a DocuSign, like those type of companies perhaps would be under threat by this. ServiceNow, Salesforce, Adobe, these companies are completely entrenched, and AI is just going to be a massive tailwind for the entire industry eventually. Looking at this too, I know a lot of people mention that this is sort of like a DeepSeek moment for SaaS. This is beyond that. Like you said, this is even deeper of a red decline, this complete downhill decline than COVID-19, right? This is absurd. I don't know when we're going to turn around. It's going to take a massive shift in the narrative. I think rhetoric from Jensen, perhaps. I don't know. That's going to be big with NVIDIA earnings.
Well, he even said a week ago in like a call, like he was asked the question, he basically said the SaaS Selloff is ridiculous.
Yeah.
I do think the narrative's not going to die until we see an overall thesis from SaaS names of turning their growth around. Like
Yeah.
if we see Salesforce come in and miss guidance or miss revenue, dude, I mean, they're going to get
Brutal.
we need to see real acceleration for people to believe, oh wait, they're actually fine, and then we'll see a massive rally from all names. But until then, like, I think we're going to keep declining until a few SaaS names have a good turnaround, or we just see the separation of the ones that do reaccelerate and the ones that don't, and then that's where the money floods to.
You know what I'm thinking here, and I'm just kind of thinking out loud. I mentioned this maybe a week ago somewhere. I don't remember who I was talking to, but it makes me think a little bit more. Right now, people are obsessed with this narrative because there is no other news to interrupt it. And so the news cycle is continuously locked into this idea that SaaS is going to die from AI in Cloud Code. I think what it takes is a significant news shift, some sort of narrative shift in the market or geopolitically to sort of knock this narrative off its edge and pivot the market. And what that could be is the SCOTUS decision towards the end of February. Depending on how SCOTUS rules, we could see the market completely bounce back and the entire attitude shift completely, at least for a couple months, because I know we are in a midterm year, and it will be a little bit volatile and choppy going out towards the November election. And then after the November election, we tend to have a market that sees more certainty and tends to trend towards the upside towards year end. But we'll have to wait and see. I do think that SCOTUS ruling could be some sort of indicator, some sort of telltale sign that the market may change directions. We'll have to wait and see.
Yeah, if I can quickly add on that, by the way, I don't know if you guys caught it, but I uploaded like a Instagram reel, like short video on it. But like, when will the narrative shift? Like, when will it be a catalyst? I think somebody asked me in a comment section. I was thinking about it, and Nate, I largely agree with you. Like, it would probably have to take some sort of reacceleration in terms of the AI or the revenues because of AI. So like if Salesforce comes out and they're like, okay, we've been growing 8%. Hey, we actually exceeded that. We grew 9%, 10%, and we're guiding for 12% next quarter because directly as a result of AI revenues that we're generating, I think that would be the sort of catalyst to kind of shift everything. We also have Salesforce earnings coming up, I think same day as the NVIDIA ones. I think it's the 24th, I want to say, if I remember correctly. So that conference call should be very, very interesting, if I do say so myself.
I agree.
Yeah, I think it's obviously that the names that reaccelerate will get all the inflow, and the names that don't will get, I mean, absolutely hammered. Which is why we're betting on Zeta, because I think we're going to see some real acceleration there. But yeah, I think I think it's honestly pretty obvious. We'll see in like the next 3 quarters, the companies that are reaccelerating and talking about the improvements of AI are going to ones that are going to thrive.
Yeah, for sure.
I agree. You know what? Just a little side tangent here. The whole idea that MarTech and AdTech is going to die as well. Like the fact that AppLovin, Zeta Global, even Meta has got caught up in this a little bit, like being sold. It makes no sense. I don't get it whatsoever. These companies, like, they're going to benefit from AI completely. Like, for example, AI is practically the core of AppLovin and Zeta Global, and these companies are being sold off as if they're dead SaaS companies. It makes zero sense whatsoever.
Yeah, it's honestly, this is probably genuinely one of the dumbest sell-offs I've ever seen in my life. Like I've invested for 7 years, and like most sell-offs, I'm like, oh, there's a reason. I get it. Like there's a macro thesis or there's something that happened. This is just straight up. I don't even know what. Nothing even happened. It's just more and more AI headlines, and so I guess that's the reason. I'm not entirely sure, but
I think there's maybe a question of like seat dilution. That one hasn't necessarily been answered. That's like kind of like a we'll wait and see sort of thing. But again, like as you mentioned, like nothing's happened yet. And most of these companies are like ServiceNow just came out. They said, even though I don't like that they shared that piece of information, but they came out, they're like, yeah, our monthly active users are growing 25% year on year. Like we're not seeing any signs of seat dilution. Healthy as ever. Anyways, Yip asks, new investment strategy, lazy. And yeah, I mean, I think we all agree here. I would like to kind of like flip that as well. Like you do want to maybe avoid companies where like it goes against human nature. I think Duolingo comes to mind. I didn't say it in the video I made on the company like 6 months ago or whatever, but it was something I was kind of thinking about of like, this is a chore at the end of it. Like nobody actually wants to, open the Duolingo. Like it's a bit of a chore, a bit of a hassle.
50 million users though.
It's gamified, right? Like it's like a 3-minute lesson. You're just trying to keep the streak and whatever.
Yeah.
But like me personally using it, like I kind of dreaded keeping up my streak after a little while. You know what I mean? So
Yeah, I was trying to learn Japanese and I stopped after like probably 30 days.
yeah, exactly. Because you're just like, okay, just screw this. Like,
Yeah.
I don't care enough to kind of keep this going. Like, I think Peloton's another like great example historically of like, you don't really want to be invested in the companies that are kind of like a chore to do. Like, it's much easier to align yourself with like Netflix. It's easy to watch Netflix. It's easy to watch YouTube, or like, getting food delivered to your house. It's super convenient and easy and like a guilty pleasure, right? Amazon, same thing. It's like better aligned with human incentives, basically. Except here, Uber
more substance to the Duolingo thesis, to be honest.
I like Duolingo.
How much first-party data they've collected.
Okay.
They have to be sitting on the largest.
This guy wanted us to use the term first-party data.
Well, it's true though. Like they must be sitting on a ridiculous sum of data, and that data is extremely valuable. So I do think that they're in a position where they can create a flywheel into different education content and platforms, perhaps. And you got to remember too, maybe the core audience isn't North America, but English is the language of business. And for a lot of the world, Duolingo is a cheap, easy way to start to gain access to that market in order to try to seriously make some money. So I think the TAM there for something like a Duolingo is massive. Now, yes, LLMs will be a threat to Duolingo, and Duolingo has to prove that AI won't kill the business. But I think they really need to lean into the fact that, especially on their earnings calls, that the data they have is extremely valuable, and the data that they can train off of for this great user experience and to really curate it for each individual person is something unique, and there's unique value proposition there. So I don't know if I won't stand here and say that Duolingo won't succumb to AI eventually. It's entirely possible, but I do think that they're in a much better position than, let's say, a Peloton was 5 years ago, 3 years ago, whatever it was.
Yeah, I've looked at Duolingo too, and like they're a $4.7 billion company. They have like almost $2 billion in cash.
Yeah,
for like 30% of the market cap's cash. Like,
it's ridiculous.
They're at a point where it's like it is sort of insane, and any ounce of growth reacceleration is going to send the stock legitimately up 100% a month. Like,
I agree, and they've lost 80% of their market cap.
Off of like basically after not much either.
Yeah, it's wild.
They were expensive. To be fair, they were expensive.
Yeah,
they needed a 30 to 40% trim, but the extra 40% is a little ludicrous. Yeah,
I think on the cash thing, by the way, a little bit more ridiculous. I put out a tweet. I don't know if you saw it, but like Monday.com, if you include their cash balance plus free cash flow, it's like 40% of the market cap.
That's insane,
dude. Like it is really getting sold off. If they do it, sorry,
that's an interesting one. Will AI kill Monday.com?
We'll see, but I personally wouldn't bet on it. I'm totally fine missing the stock going up. You know what I mean?
I don't think it will.
You don't think so?
No.
Why?
I think it's too early to even tell. And like you said, like I use AI to help improve my workflow, not replace what I do or change what I do. It helps helps me do extra things and saves me hours, but it doesn't just entirely replace a platform that has all of these. Like I think I saw David Sachs say, like, you really think Salesforce, who's been a live enterprise for 20 years with probably at this point millions of bug fixes, are just going to be replaced by some Claude code? Like, is this a joke?
We can't be naive though. We can't be naive and basket both Salesforce and in the same.
Definitely different companies.
One is small, medium-sized businesses as a core audience, and one is enterprises that have integrated Salesforce for like more than a decade. Where Monday.com, what did they really break into the market? 2020, 20 or 2019, somewhere in that window. So they haven't been around quite some time to really be entrenched into the core function of the average business. And not to mention, small, medium-sized businesses, they don't need that corporate governance enterprises do, right? They don't need to audit their business to the same degree enterprises do.
Is Monday.com not using enterprise? I know Jira is obviously probably the winner in enterprise. So Atlassian, but
I'm sure some enterprises use Monday.com, but their core audience is the small, medium-sized business, SMBs.
Yeah, for sure.
Got it.
Albeit I also put this out like pretty recently. Like Monday.com is one of the best in terms of breaking out sort of like, their users and stuff like that, or like their customers. I wish Adobe did something like this. They have 252,000 customers. About 4,000 of them spend more than 50,000 per year. So these are sort of, quote unquote, more enterprise style companies. That accounts for almost half of their total ARR, and this is increasing over time.
Okay, yeah. So they do have a significant portion of enterprise.
Yeah, I think what happens is we just see a consolidation. We see like platforms like there's other ones that are way more SMB, like ClickUp, Pipedrive,
Yeah.
WorkZone. Like I think all of those way smaller platforms have way less enterprise customers and just way less users in general. They just get either A, bought out, or B, just get outpriced
Yeah.
by an Atlassian and a Monday.com. I
Yeah.
think we consolidate to a couple winners of what happens. And I think Monday.com becomes a winner in that zone.
Okay. I could buy that. I think it, I didn't know that. So that bringing up that KPI right there is actually very
Fiscal AI 2-week free trial, no card required, using the link in the description down below. This is a custom metric I made. Only platform on the world that can do stuff like this. Put another way, by the way, about 2% of their customers account for 40% of ARR. So I mean that speaks volumes, right?
Yeah, it's crazy. So they're trading at a 17 forward PE. I know that's not GAAP. Aria would slap me on the wrist. That's not GAAP. But you know what I mean? So call it 20, right? Roughly, or somewhere in that window. Is it worth the risk right now? Would you go in on Monday.com and say, yes, I think this is a good long-term investment?
I think I'm go ahead, Ari.
I was gonna say it's really tough to say, dude. Like I'd rather invest in stronger moat software companies than say Monday.com. I probably acknowledge that, like, I think the stock works out from here. I also thought that at 150. Do you know what I mean? And it's literally down 50% since I was thinking like, oh, surely this is the bottom on Monday, right? Like it doesn't get cheaper than 30 times cash flows growing 25% a year. You know what I mean? And here we are. So it's tough to say.
I'm really big on management team, and so I'd have to understand more what their management is like and how they talk and just how they articulate what they want to do in their growth plans. I do think if I were to just take a blind bet, I think in 3 years, Atlassian, Monday.com, and maybe one other big PM platform will be okay and we'll do fine.
Probably Asana.
So I would, Asana as well. I think I would take the bet on it, but I would need to hear how they view this whole Selloff, how they view this AI agent stuff. Like, are they incorporating? I'm sure all of them are kind of forcing themselves to. But I just would be curious to see what management thinks and how they view it.
Moving on along, we have a lot of comments to get through. Uber still isn't that big in Europe. Lots of growth left. Definitely, totally. I mean, just Germany alone, right? Like it's 1% penetration in that market. That is what, the 4th or 5th biggest GDP country in the world. That is so much white space to drive incremental revenues from. They are currently making a big push into Germany. I think literally today they announced they're going into like Finland, Denmark, a couple of different like Western European countries. So Europe alone is, pretty like high average revenue per user sort of consumers in that market that they can capture. And penetration wise, they're very low. I think it's definitely a market that kind of lends itself well.
I'm curious on this, or I guess I have a flip side of view on this.
Mm-hmm.
I guess I would like to see the metrics of public transport in the US versus Europe, because I feel like Europe is a lot more heavy on public transport, being the times I've traveled there and a lot of Europeans I know. And so, like, yes, the penetration in North America is 25%, but I'm curious to see, obviously, like you said, if it's only 4% in Europe, I still think there's growth there. But I do think it has a much lower ceiling than in North America in terms of penetration, just because of public transport and how transport is viewed there in general.
Actually, I didn't consider that. Yeah, no, you're totally right on that. Nick?
I was saying Uber Eats. They don't need transport. They'll just Uber Eats everything.
See, that's what I'm saying. Uber Eats, I feel like, has a TAM. The penetration anywhere in the world is crazy.
Yeah. Actually, Uber Eats makes up like close to half their gross bookings, less on a revenue basis, but still, it's a monster in of itself. It's growing faster than the core business as well, so pretty nice. Uber can grow in the big cities. Elsewhere, people own cars and use Uber to go to the bar, etc. Not comparable to Meta for long-term growth, in my opinion. So I would kind of they basically gave us this. It's not broken out specifically, but they kind of group the different markets into like sparse markets and like metropolitan markets. Basically, they've consistently maintained over the past 2 years that the sparse markets, say suburbs and stuff like that, have been growing significantly faster than in the big cities, particularly in the US. That's been the case. And I've even anecdotally kind of seen this myself of the the ETAs. I live in the suburbs. The ETAs from where I live have consistently gone faster over the past 2 years. Where 2 years ago I might have waited like 5 minutes to get a ride, it has gone down to like 2 minutes. And I promise you, I live in a very, very suburban area. But again, that's just an anecdote. I do still think though, like, I mean, in a world where like Meta has what, like 4 billion daily active users, like not the best proxy, but like the point is like the world is a very massive place. And I think people kind of underestimate that. That could be a massive secular tailwind for them for multiple years to come. And then let's see. Oh boy. What is ROIC but use unlevered? Do any of you guys know how to answer this one?
What is return on invested capital but use unlevered
Funds from operations before WC and numerator, working capital and numerator? I don't think any of us are that big into the return on invested capital.
ChatGPT.
I don't like that ratio. I think it frequently kind of misrepresents what it's supposed to. There's a lot of like, especially if a company does an acquisition, like the ROIC and ROCE kind of like, they kind of like go artificially lower for a handful of years while they amortize the intangibles. I don't like those ratios. Okay, and then Caden asks, what is the greatest opportunity right now?
Zeta.
This guy's immediately going to say Zeta.
No, but in all seriousness, I think AppLovin is actually really attractive right now as well. I won't lie.
I saw you tweeting about them.
Yeah, I think AppLovin looks really good. I think Zeta Global looks really good. A lot of these ad tech, martech names, I think we're going to have a gangbusters year. You got to remember it's midterms. So you're going to see a heavy ad spend. There's a reason why Meta is guiding for 30% year-over-year growth minimum, right? I think the top end, they guided, 33%, something like that. So yeah. I think, and you look at Reddit, you look at Amazon ads, you look at Google's performance, everybody's doing great in terms of ads. So I think any of these martech names or ad tech names that are being caught up in this sell-off, the SaaS sell-off, that specifically have defensible moats, meaning they either have first-party data or they are a walled garden of some capacity. I believe that these companies are easy wins long-term, very easy wins long-term.
Just for the audience, in terms of what walled gardens are, that you're just referring to Amazon, Meta, and Google, basically, right?
Correct. Yeah, correct.
Yep. So I guess on the flip side of that, what if we go into a recession? Obviously, the commentary is always, marketing gets cut first, ad spend gets cut first. Obviously, for politics, it doesn't. But let's say we go into a recession as in 2027. I think that's sort of the worry we're seeing of like the 1 million less than revisions of jobs, the worst in 2 decades. We're seeing more and more scare of it. Obviously, I feel like it's always been on the topic. But can you answer the question of, if we do get into a recession, then how does Zeta and these other mad marketing platforms handle it? I'm not sure how Zeta's handled it in the past in terms of like, I guess 2022 would probably be the best period of how they handled it then. But just curious on that. I guess you can answer with the dog.
Yeah. I'm dealing with a barking dog right now, so I'm sorry if it sounds kind of horrendous. But to kind of summarize, during recessions, you have this weird conundrum where brands have to attempt to market in some capacity in order to make money, because if they don't sell their product, they're going to go under, right? So they have to be very pointed. So what do? They tend to collapse in on the names that can guarantee them a return. So companies that have first-party data, who can identify people on the device level or the identity level, are going to stand out as winners during a recession, because that means the spend will collapse in on those individual companies who are able then to point out individuals or potential customers who will next to near 100% buy their product. And that's why I'm very, very bullish on companies like Zeta Global or AppLovin or Meta, for example, because they have a ton of first-party data, and first-party data will help you navigate through a recession. So yes, the stocks will sell off no matter what. Every single stock will. And ad companies will sell off in general. But at the end of the day, you want to back companies or put your money into companies that have the data, because like I said, the the corporations, the enterprises, whoever it is who is spending the money during recession, and there won't be much of it, is going to put their money behind names who can make those links, who can find you the customers.
Yeah, for sure. And another sort of thing to maybe add on to that, I think a lot of people, and even me personally, kind of underrate the fact that these companies, mainly sort of like Meta and Google, I think are the biggest, like most pronounced versions of this. What you're looking at here in the orange is the number of ad impressions delivered, and the blue is the price of these ads. These two things you might notice are very much inversely correlated. So when we go into, for example, a 2022 environment when the prices of these ads fall off, because obviously if there's less advertisers total, then the price to advertise obviously goes down. What Meta has historically done is they kind of ramp up the number of ads that you see on the platform. These two things are inversely correlated. So this way, you don't get a year where Meta gets a 30% haircut to their revenues. That has historically never happened, because basically if the prices of ads fall off, they just end up showing more ads total, right? And so they're able to pull on these two different levers, basically. What happens to their profits in that scenario? In that scenario, the profits do end up taking a hit, and the revenue growth probably does slow down, but it's sort of like a temporary issue. If we go into an ad recession, if you will, I can't imagine that be longer than a year and a half-ish. Historically, that's how long these quote-unquote ad recessions and adpocalypses have lasted. It's been about a year, a little bit more than that. If you are a generally long-term investor, that shouldn't impact you too much. Not to mention the companies in it themselves have levers to be able to kind of defend against that sort of an environment. For maybe,
So can we use this as a corollary between a recession? I mean, because we can see them slowly increasing quarter over quarter for the past, 4 or 5 quarters. Their percentage delivered.
yeah,
I don't know. I've never even seen this chart, but this is interesting that you kind of could see 2022. They went from 17 to 23. So if we continue to see this increase in Meta, I feel like we're sort of witnessing it firsthand.
that we are going into a recessionary environment. I mean,
Yeah,
if the trend
at
is,
least in the ad space, maybe it's not
yeah,
entirely able to, world, but yeah, it's interesting. I like this chart.
yeah. And then again, like you could see, it literally peaked in 2021 in terms of there was a massive ad boom during 2021. Like it was growing 40. Granted, comparables here, right? So what is it? June of the prior year was lower, so that also plays into it. It was like a depressed comparable the year prior. But nonetheless, yeah, you could see the correlation over time. And if this trend does hold, Nate, then yeah, it seems like we are going into a ad recession-ish, because the prices are kind of growing a little bit slower. Anyways, we have like 20, 30 different comments. I don't know how many more of you guys.
Rank them through, baby.
Yeah,
okay, all right. Got to hear about y'all's favorite Max 7 in terms of current value, but just in general, moat question as we enter the AI era. If I could start off, I just did a video on Meta, and dude, I have underappreciated this business for far too long. This is such a phenomenal company. I was kind of highlighting, and Nick, I totally credit you for kind of coming up with this idea, but the e-commerce opportunity with like a Meta shop sort of business, if they're able to create something like that, is massive.
Oh, yeah.
And another sort of stat that came up as I was kind of like researching it was, and it totally makes sense, 90% of Instagram users follow a business account. So you are, as a user, opting into what you're interested in. If I'm following the Nike page, at a bare minimum, I'm somewhat interested in Nike products and the Nike brand. That first party data, that's so massive in terms of targeting. And you open the app, they put a pair of Nike shoes right in front of your face. Maybe you click through it and then you buy. In that scenario, Meta would be able to take a cut off of driving that traffic over to Nike, independent of Nike placing an ad in your timeline, right?
Yeah, I think in the next 24 months, Meta and Nvidia especially, are just so obvious to me. I mean, we're seeing these companies are doubling their expectation of capex. Who is it going to? It's going to Nvidia, like literally. Maybe not all of it, but the trend is there, and like it's clear as day that Nvidia is going to just rake in the dough over the next 6 to 8 quarters. When you see Zuckerberg come in and say they're going to spend $40 billion more, you see Amazon come in, they're going to spend $200 billion versus 135. Like, it's insane, and it's all going, or most of it's going to GPUs, which is the winner, Nvidia. And so to me, Nvidia and Meta are easily they're just going to be such easy winners over the next 5 years. Both I just also personally prefer founder-led companies, and so those are also why I picked those. I think Andy Jassy is great at Amazon. Obviously, he came with AWS and led that. But yeah, I think Nvidia and Meta would be my 2 picks if I had to pick 2.
if I can say, Amazon as well I know, a lot of people don't necessarily love it recently, but they came out, I can't remember exactly who, but some, like the head of robotics at Amazon, something like that. They came out and said that by 2033, they expect to double revenues or double the e-commerce size without hiring more employees. Where is that operating leverage coming from? It is entirely coming from them getting more and more into robotics. Currently today, there's a stat which says 75% of orders on Amazon have robots, doing some part of the work to be able to get that package to your house. So there is a huge amount of operating leverage that they're able to exercise over the next handful of years until 2030, say. And that's going to show up in the margins of the business. Granted, this is going to be additional capex and maintenance capex to have all these robots in the fulfillment center, but it's already in the fulfillment centers today, and it should kind of help with the margin structure. Nick, did you have something to add, or?
Yeah, so I'll kind of talk intermittently here between my dog barking, but I'm quite bullish on Amazon and Meta. I think Meta more so at the moment, but Amazon too. I have a couple quotes here I captured on Friday from the AWS CEO. The most significant one, he said, quote, "Today, by all estimates, less than 20% of workloads are on the cloud." And then he went on to kind of allude that the company is going in this direction where they anticipate the on-ramping of on-prem servers to on cloud, and you're gonna have this massive enterprise shift because everybody wants to utilize AI, and there's no better place than to do it in one single ecosystem, one environment, one single stack. And so to me, that's just this huge indicator, green light, that says AWS demand, Google Cloud demand, Azure demand is going to go through the roof. So on the bright side for somebody like Meta, I think Meta, doing cloud work too is quite a green light. But their ad business is something that I'm most excited about, specifically with the e-commerce side. Arya talked all about it, so I won't bore you guys. So those are my two picks: Amazon and Meta.
Yeah, I think. I mean, sorry. Anyway, Nvidia I think they're so undervalued, man. Doing 60%, 65% operating margins, 40% free cash flow margins, like.
Meta?
Man,
sorry. Nvidia. My fault. Nvidia. What were you saying?
My semis pick is AMD. I think I prefer AMD right now just because of the inference. We're going to a cycle now where inference is going to be at the forefront of everybody's mind. And AMD is leading that. Their inference chips are actually better than NVIDIA's. So yeah. I think you're going to see some uptick there. I don't think that they're going to do more revenue than NVIDIA, but I think they're going to do faster revenue than NVIDIA.
They're going to go faster than 60%?
Yeah, I think so.
Well, that's above my pay grade. I'm just the ASML shareholder here. I did a video on what was it? I don't know. I did a video on the Amazon earnings, and I mistake saying the x86 chip is a GPU.
How dare you,
dude? A couple people in the comments were like, "Arya, I love your videos, this and that." But dude, you really got this one wrong. And I was like, I'm so sorry. Anyways, Lethal Illusion asks, Arya, what do you think causes market mispricing? Oh, this is a fun topic for us. Well, a lot of it is narrative driven, right? I mean, let's take, for example, so in most cases, a big sell-off does have some sort of merit to it. I think this SaaS sell-off is one of the only ones where it's like, this is so baseless, and like, this is just fear in the market. And to kind of look at that, like, it's like, dude, like, FICO, which is, it gets 90% of operating profits from selling credit scores, right? They got sold off like 30-40% in this SaaS sell-off, just simply because S&P decided to categorize them as a software business, and it's included in the IGV ETF. So this is a broad market sell-off of software. Anything that is categorized as software, I don't think, people selling their IGV shares, they're not necessarily looking at like FICO in particular, but it's getting sold off because it's categorized and included as a software name. So that's baseless. But if you take like Meta, right, that had a lot of merit to it of, okay, there is increased competition from TikTok. Are they going to be able to kind of respond to this and integrate Reels? That wasn't clear at the time. Zuckerberg has decided to dump $20 billion a year, the equivalent of like 5 Disney parks. He's spending 5 Disney parks per year on to make like like animated GIFs. Like, what is this guy doing, right? So that combined with the Apple privacy issue, so there was a lot of things going on with a Meta like that. Your job as an investor in that moment is to kind of digest all this information and try to make an educated bet of like, oh, okay, well, they're going to create Reels, and will that gain adoption? They have the distribution, they already have all these users, and kind of be able to decide on something like that, whether or not you're willing to invest during a sell-off like that. For the most part, market mispricings and stuff like that happen as a result of narrative, in my opinion.
Yeah, I think I'll give a quick answer. I think a lot of it's like he was saying, narrative and also algos. I think
Yeah.
algos see a headline and just trigger a 10% sell-off, and then that creates this narrative, and then it just kind of is a downfall effect. Or on the opposite side, a euphoric effect. And so, yeah, I think it's just narratives and algos.
Yeah, I agree. Any narrative that creates uncertainty. That's the key word, uncertainty. Markets hate uncertainty. And that's why you're going to see, no matter what, every single midterm or election year, every 2 years, you're going to see uncertainty in the markets. And the markets are going to be very choppy or sell off, and they'll be very sensitive. So we're in a very sensitive ecosystem right now. And I'm not surprised it's selling off. Speaking of, Ari, I just want to mention, FICO's down 44% from all-time highs.
Yeah.
44
from all-time highs, but like since
Crazy.
like the recent $2,000 high, it's not as much, right? It's like
Yeah.
35-ish%. The all-time highs, I mean, it was trading at like 120 times earnings, growing 30%. So it was decently overvalued. But it's now below my cost basis, which is always fun. So if only I had more cash, right? Anyways, another gentleman here asks, what do you guys think about Constellation Software? I'm generally bullish on the business. I did a video on them. So, I mean, if you want my full thoughts, in-depth thoughts over there, I'm just trying to get through some of these comments pretty
Yeah, I was gonna
fast.
say I've never heard of Constellation Software, but I just looked at their website, and my God, it's built from 2007.
Yes.
I put it in the private chat. I don't know if you want to share it real quick, but Lord.
I don't think we need to really waste time on that. It's a serial acquirer, so they buy like vertical market software. It's like chicken coop software, like very small software companies is what they generally tend to buy. Thanks for Luz. Names like Zeta and Dual, I was thinking of. Clearly the moat is data and stickiness of the customer base. I'm also following other names too, but I think some of these will bounce back. I mean, yeah, I think they'll do okay, right? Why doesn't Google pause CapEx for a year and buy out Uber? Oh boy. Do one of you want to take this? It would be a regulatory nightmare for starters.
Yeah.
And I don't think in the middle of the AI arms race, it's the best decision to be pausing CapEx to buy that sort of company. At the same time, like there's an argument, not an argument per se, but like something I've been thinking about is like, why is Waymo raising outside capital? Because Google doesn't own all of Waymo. And I think part of that is it's not as important of a battle for Google to be winning. I think the more higher ROI, more predictable sort of spend for them is going to be dumping more and more CapEx into these AI GPUs. And so to develop their cloud business, right? And so although like Waymo and autonomous vehicles is a big opportunity via Waymo, I don't think it's the best battle for them to be fighting and continuously backing the losses of Waymo. When will the narrative change for Uber? It's hard to say with these sort of things, right? But I would imagine eventually, like once they get once they can demonstrate that there's 10 different autonomous vehicle companies and they get them on the platform and the rides are happening on the streets, I think that's when you might see something like that. Really bullish on Shopify. Haven't heard much talk about it during the drawdown. Y'all have any thoughts? You guys?
I love Shopify as a company, as a product. I think Toby Lucky, it's like probably the best Canadian company that you guys have been able to put out up there. But yeah, I love the company a lot. I think I love Toby Lucky's approach. Yeah, if you look at the past 5 years, it's down 25%, which is insane. And I didn't realize it's down 30%. Okay, I got to look into Shopify, honestly. I like the name a lot. So
it still trades at like 12 times sales, but I mean, it kind of deserves that premium relative to the other SaaS businesses.
I think it's a good premium.
I think it's an understandable premium. And by the way, the reason why it's down is because I think it like peaked at 100 times sales, but like 5 years ago it was trading at like 60 times sales. So it just goes to show, right? Like I think revenues are up 200-300% over the past 5 years, maybe even more, and yet the stock is still down. So just got to be careful of that valuation there. I did ask Cloudco to dual app and it spit it out, but it clearly is not that easy. Yeah, I tried making Adobe on Claude. And like it made it, but dude, like I can't even upload photos. Like there's a button to upload the photos, but you click it, it doesn't load. If you want to like bring on like a little coloring thing or a drawing thing, doesn't work. So Claude is, I'm not quite sold. Maybe I'm doing something wrong, but I'm not quite sold on its capabilities. There's one of the biggest beneficiaries of AI. Oh, Nate, maybe do you want to take this one? It's Hims and Hers.
Is all Nate.
One of the biggest beneficiaries, I think data is the moat there, and I wish they would focus. I don't want to get too much of my rant, but I think Labs is a great product, and I think if they continue going that route of doing Labs and focusing on the data side, I think yes, they will crush. One of the biggest beneficiaries, I don't think not soon. Maybe in 5 to 10 years, probably, but not in the next 8 to 12 quarters.
Fair enough. I don't think any of us have really researched either of these businesses, so
Yeah, C Limited. I don't
apologies.
even know what Vive is, but
It's a CR for healthcare, I believe. I messed that one up. Apologies. Next lever dual will be certifications on no position, but following. I don't have any insight on that one.
I actually do think long term, Dual can create a bigger moat with, like you said, certifications and being able to get certifications on their platform.
Yeah.
We don't have to get too much into it, but I do think that's a big avenue they could hop into.
I agree.
I mean, no, actually, we could get into it. Like, are you saying like for people to like migrate to a different country, you have to get like you have to be proficient at English to a certain degree? Is that what it is?
I mean, that could be one avenue, but also like if you want to get any certification in any software platform, or other avenues, I think Dual could be a good platform to orchestrate that certification, and take a fee between, essentially.
Interesting. Axon is really the one that doesn't deserve to be sold off. So this is the like police body
cameras,
cam
right?
and
Yeah.
evidence.com and stuff like that. To my understanding, yeah, like they have a pretty wide moat, and
Yeah.
I don't think the advent of increased competition is going to change the moat at all. Like it's like absurd switching costs, and it's kind of built in with the hardware of the Axon cameras connect with evidence.com, and it like automatically updates and stuff like that. There's so much migration costs involved with something like that. So yeah, I would definitely agree with you. This one historically trades at a big premium. I think it still trades at 10, 12 times sales. So
yeah, it's
definitely
that
tells you
Axon
something.
got sold off. I didn't even realize that.
It's 35%. Yeah,
That's
insane.
insane.
It's down like 50% from all-time highs, right? Like it was at 900 at one point. I think it's like close to 500 now.
Mm-hmm.
Yeah,
Thereabouts?
it's down. Yeah, it hit 870 at one point. Now it's 425.
Wow. That is,
So-
dude. Do you know what I saw? I was looking at Intuit, and that one's below 400
Oh
now.
man, that one is crushing.
Wow.
Getting
Really, it's
murdered.
below 400.
That's
Below
crazy.
I have
400
not been
now.
paying attention. I did not realize these
Okay.
names are down so much.
Trades at like 25 times earnings. Just like that company always trades at like 60 times earnings. You know what I mean?
Wow.
It's crazy. Hi guys, 2 questions. When the market sees that the narrative was wrong, I hope so. How many shares will Adobe buy back? 34. Whoa. How do you see this? 2, are you interested in Netflix? So it's a bit funny. Like I think with PayPal, this kind of started where they're like, oh, at this rate, they're going to buy back the whole company. But what you miss in that is like, for every like, for example, 10% decrease in shares outstanding, the stock should be rising about 10% as long as they're still like creating value and stuff like that. So like, sure, on a current market cap basis, Adobe, if I think what's their market cap today? Adobe market cap. Oh wow, 108 billion. Okay, so like if they were to pour like about $50 billion into buybacks, that doesn't translate to like 50% net share count reduction, because they wouldn't do that right away. They would kind of do that over a number of years. The stock should be rising as they do those buybacks. So I don't think they're going to be buying back 30, 40, or 50% of shares unless you're looking out like 10, 15 years. That's
Sounds like a PayPal thesis.
It's not. It definitely is not. Don't call my.
No, I
Adobe
mean the bought-back shares part. But
He's personally offended right now.
no, I meant just the buyback shares part. That was like the whole PayPal thesis. Oh, they can buy back their whole market cap in shares or something.
No, the PayPal thesis was they are going to spawn an advertising business in the next 3 months, and it's going to do $2 billion of revenue out of the blue. That's for reference. That would be the fastest scaling advertising business in history by like a factor of 2. Like if you look at how long it took like Google to get to 2 billion, how long it took Meta, how long it took Uber's ads business to get to 2 billion. I think Uber was one of the fastest ones to scale their advertising business. It took about 4.5 years to get to $2 billion of revenue. So these guys were talking about like, yeah, within basically a year of launch, this is going to be a huge uplift to revenues and operating income. It was very obvious that will never happen. Uber in Germany is completely different. Not private drivers, freelance. Uber is similar. Actually, I have a pretty good German friend that I've talked to pretty consistently about Uber. He has told me about the dynamic is a bit different there. Nonetheless, it's a market that they're pushing into. I trust management will be able to figure it out and kind of adapt to the local market there.
I think that's an important thing to stick on though, Arya, that
Mhm.
I always emphasize management. Obviously, you never trust management blindly, but I do think people need to, when they do invest in companies, take management more seriously or use that as more part of your thesis. Because, like you're saying, obviously the dynamics are different in Germany. You don't live there, you don't know as much, but you still trust and believe in management to allocate the capital wisely to grow. And then if they do see a ceiling or if they do see some limited growth, to move to a different country to allocate the capital to a different growth vector. And so I think just I just wanted to hammer on that a little bit that I feel like people need to take management as a larger part of a thesis when investing in companies, because they drive the culture, they drive the growth, they drive everything, right? And so I just think it's something important to I want to hit on.
Yeah, 100%. I mean, you see this all the time. As I've kind of like matured as an investor, I've learned the importance of having a good management team at the helm. And in my opinion, based off everything I've seen with interviews of like the C-suite of Uber, which by the way they do a lot of interviews compared to like your average company. I trust management. I think they have a really good grasp of the business and the markets they're in, optionality with the business, etc. So I trust they'll figure it out. I'm told in Denmark in particular, it's like a very anti-capitalist sort of culture there. They're very anti big business, more trying to kind of like support local smaller businesses, stuff like that. This is what I'm told. I don't know for certain. And so that's part of the reason why like Uber hasn't been able to penetrate into that market yet. I believe they exited previously. Now they're going back into it. So we should see. But again, I'm confident they'll either figure it out or buy like a local company that is already holding a pretty dominant position.
I find that ironic, right? Like they're anti-capitalist, but they have one of the world's largest
Novo?
successful sovereign wealth funds. It's like,
Oh no, that's Sweden.
oh no, sorry, maybe that's Norway. Maybe I'm getting two.
Oh yeah, it might be Norway. Yeah, you're right.
Yeah, I mean, we don't even want to bring up Netherlands 36% unrealized gains tax. That's a different level.
Is that really a thing?
Yeah. Yes.
Wow. So, but
I
how
mean,
does
just
that
think
work?
about this. So at the end of every year, the tax you 36%. Think about this. You own a volatile stock like Tesla. It goes,
Yeah.
they say, okay, January 1st, we're going to tax you 36% of your unrealized gains. Then throughout the year, Tesla falls 50%. You're still going to owe that tax bill of the 36%. And now your stock is worth half of what it was.
What?
The logic of this, I don't know if it's been approved. I don't know. I think it's still in the government talks. I don't know if it's actually been like signed and it's happening. But the fact that it's even considered is just delusional to me. I don't even understand it. It's insane.
No, there's no. So okay, but hang on. If my stock falls in the following year, do they pay me? How would that work?
Nope, they don't pay you.
They just tax you. That is the most.
Every year they tax you. It's insane.
Home of Max Verstappen, dude. That's a terrible.
I know there was conversation of that in Canada happening, and everybody shot it down immediately. It's just complete idiocy.
It's so stupid.
Anyways, next question here. Anecdotal: when going out, I almost always use public transport for the way to the location and Uber at night to get home. Yeah, fair enough.
Actually, it's kind of similar in Chicago. I just Uber there and then for public transport there, Uber home.
I use Nano Banana to create thumbnails for my brother's YouTube. Well, yeah, thank you for that piece of information. No, you know what, dude? Like, I think Nano does a decent job. I've made one thumbnail.
Yeah.
On Nano, the issue is the element of control, right? Like, it's like I made like a moat. I made a castle with like a moat around it, and like I was asking, I was like, okay, but like, can you make the moat bigger? And like, bigger is such an ambiguous term. Like, it's not able to kind of capture like how much bigger does Aria want this. So it'd be better if like, that was in a interface where I would be able to kind of like stretch it or like be able to quantify it. Maybe if there's a slider that I'd be able to do, cough, Adobe. So yeah. Next up here, why invest in Zeta when you can invest in Meta? Oh,
Zeta's going to grow faster than Meta.
What?
Yeah, I think
simple as that.
For me, it's just more of the market. It's like, it's a great question because it is a fair question. I think for me, it's just about like, obviously the sell-off between Zeta and Meta in the market cap size, and I just prefer investing in smaller market caps. Obviously, there's more volatility, but I think you get a greater return if you play it right.
No, I agree with you. I agree with you. And I mean, I reduced it right away to a very simple argument of, I think eventually Zeta is going to be growing at a much higher clip or faster clip than Meta will. And I think when the market prices that in and gives it the premium it deserves, the upside is phenomenal. Compared to Meta, I think that because it's a mega cap company, it doesn't move the same way like a company like Zeta can move, and keyword can, right? Like it's a small mid cap company, so you got to be careful. There's obviously more risk inherently, but it depends on what your circumstance is, right? Like, I think the three of us are all in a position where we can take significantly more risk than the average individual investing in, let's say, their 40s, 50s, 60s, right? Where Meta is a no-brainer for them. And in that circumstance, maybe that's the best choice for you.
Yeah, I think again, to bring it back, it's just about risk versus reward. Like we know, Zeta's unprofitable, but I think, obviously, I don't think it's really priced in my opinion, or actually just kind of now being priced into sold down to $2 billion company. But yeah, I think it's all about risk to reward, simply put.
If I can add also, like a lot of people, it's much easier to understand the business of Meta. I mean, you probably use Instagram, WhatsApp, Facebook, whatever. Zeta is a B2B company. It's an enterprise SaaS-ish company, right? So it's like a bit more difficult to understand. I would advocate for invest in your circle of competence. Invest in businesses you can genuinely understand. Don't just be buying Zeta because it's optically cheaper and higher growth, et cetera, because even though that is true, and that was true when the stock was at, $20 a share, $25 a share, you go in a 40% drawdown and you really get tested in terms of whether or not you have the conviction in the business. And you only have conviction in businesses you truly understand. So to me, like I haven't thought about it twice. I haven't even thought about selling or anything like that. I'm sure you guys are the same as well. I would personally advocate for, if you can acknowledge that, I probably don't understand this business, don't invest in it. And yeah, that's just my piece of advice on that. What about Trade Desk? Nick, did you want to?
I wouldn't touch it personally, just because I made a post about this today. I believe Trade Desk is in a position where Zeta is just going to completely erode any sort of moat they have. They completely rely on network effects of their clients, because the clients bring the first party data essentially, and it's open source, so anybody can utilize it. Now, their idea is that we want to create a network. We want to create the pipes for the infrastructure. And the problem is that when you have a competitor with first party proprietary data that nobody else can touch, and because of that, they're able to offer you a better return on every single dollar you spend, they're going to leave your network and go with your competitor, because it only makes sense. So that means that as slowly but surely those clients leave the Trade Desk, their value of their network starts to deplete over time. And I think a company like that is no match compared to Zeta, Meta, the walled gardens, and something like AppLovin. AppLovin is trying to bridge out of mobile gaming ads into general web ads right now. They just have a new deal that harvests like SKU level data from Shopify stores, which is really cool. So they're trying to branch out. So they're kind of getting into that market as well. They rely on first party data. So it's interesting. To me personally, I wouldn't touch Trade Desk because I view them as a company without a moat.
Fair enough. I haven't done too much research into it. Funny enough, I actually owned it for about a week. I lost like $20 on it. So I mean, it's irrelevant in the grand scheme of things. But I bought it and sold it at like 75 and like sold it at like 73 or something like that. This is after like the initial drop off of the quarter. A case of invest and investigate. I just, after researching it a little bit, I'm like, okay, screw this. It's too much work. Screw this. Worked out in my favor though, eh?
Yeah.
If I can quickly ask the audience, I mean, it would cost you guys nothing if you could just like the stream. It would, help out the channel massively through whether you're watching this on my stream, on Nate's stream. That would be greatly appreciated. We got a couple funny ones here. Ronnie says, super nice mountains there. And then, are we watching Night of the Seven Kingdom?
Oh yeah, we are. I'm pumped.
Dude, I gotta catch up. I'm only on the first episode.
Oh, it's so good. The first two are a little slower, but they build the basic characters. But yeah, these last episodes have been, to me, what feels like season 2 through season 5 of Game of Thrones, like peak Game of Thrones. Great writing, great characters. I'm pumped for tonight's episode for sure.
Yeah. Aiden says, "What are your thoughts on AppLovin?" I delegate all thoughts to Nick.
Well, I'm in the middle of researching this company quite thoroughly right now. I'm quite impressed. They have a deterministic data set. It's device deterministic. It's not identity deterministic. What that means is that they're able to tell you the core revenue. I'm talking about what they produce right now in revenue, not what they're working on in the future with Shopify and whatnot with their SKU level data. But as of right now, they're able to say, hey, this device is behaving in a certain manner. It does A, B, C, D, F, G. We believe that it's going to be on this app at this specific time because they stay here with this certain time variable, et cetera, et cetera, et cetera. It's very similar to what Zeta offers, but Zeta offers down to the identity. The reason why AppLovin can't do that is because they have to adhere to Apple's and the Google Android stores sort of privacy rules, which dictate that they can't track an individual. They can keep information about a device, but they can't keep information about a specific individual. So it's inherently not as accurate as something like Zeta Global that uses first-party proprietary data outside of these walled gardens and these ecosystems. But AppLovin, what they've been able to do is they've taken machine learning, AI, and they've been able to take information from all over the place, mash it together, and give you a very high resolution result that says, with a high degree of certainty, we guarantee that this device will be on this platform and be very responsive to your specific ad. So that just shows you that this is an AI company at its core, in my opinion, and it's ad tech, right? But they're bridging into a new market because they're finding a lot of pressure, especially from the regulatory bodies, because of what they're doing. Because they're kind of circumventing some of the privacy rules, coming up with their own sort of technology in order to kind of patch all this information together to create an actual deterministic resolution that can help them sell their product. So I think through the business lens, I think it's a very attractive business. It's something that I would be completely comfortable owning alongside something like Zeta Global. I do think eventually there's going to be some crossover there. The one key difference here is that Zeta actually goes down to the identity layer. The question will be, can AppLovin produce a product that they can advertise on the open web? We're talking not just on mobile games, that can rival something like the walled gardens or Zeta Global. That's to be determined.
Nice. I don't have any sort of special insights on the business. Anyways, we got a couple more here, and then I think we're gonna wrap up the stream. Rubrik doesn't deserve to be sold off as well. Have you guys looked into this company? I think it's cybersecurity, if I'm not wrong.
I've heard Sam talks about it a little bit. He's been pretty bullish on it. I don't know much about it, to be honest with you.
Yeah, me neither.
But I do like cybersecurity as a sector in general. I think they'll actually probably be one of the biggest beneficiaries of AI.
100%.
Moving forward, as people try and try and hack with AI and go that way. I mean, it's just cybersecurity it's here to stay for decades to me at this point.
For sure.
AI malware, man.
Yeah, honestly, seriously.
That's devastating.
Agentic malware.
Agentic malware. Full-on code malware.
It can't be caught with agentic malware. Axon is so cheap here. I haven't looked into it too much, but I would assume it's definitely cheaper than 50% ago. Just bought ANET, Arista Networks, based on data center build-outs. Good move. Also have 900 shares of Zeta. Jesus Christ. Yeah, I haven't looked into the ANET business. There's this fun chart Ryan puts up on the fiscal chat on the fiscal account. It shows because I believe Cisco is a competitor, but it's like the growth of Cisco versus Arista since Arista IPO'd, and it just blows them out of the water. It's like Arista's revenues are up like, I don't know, like thousands of percent, and like Cisco's up like a measly 40%. So they're both in, I believe they're both in the networking business for data centers, right? So something fun to maybe go look for. Austin asks, Adobe has been abusing their customers without providing additional value, just like PayPal. Wow, it's quite the accusation there, Austin. I don't know. You could make that argument, but I think that just really speaks to like the enterprise sort of tilt that an Adobe has, and they're able to consistently raise prices with, again, as you kind of say, like with like minimal sort of value. But again, I would argue with you in terms of like, are they really not providing that much value? I feel like they're providing a huge amount of value to the workflows of these users. And on top of that, I mean, if you just tune into Adobe Max, like, dude, they just unveiled like 27 new features. 24 of them are AI integrated features. So I feel like the company is innovating across the board, maybe on like a app to app basis, not that much, and they're consistently raising prices. So there's push and pull with that argument. Bought Zeta because of you, Nick. Thank you.
You're welcome. Don't do your own research, please.
Yes, of course. Oh, dude, I put up this Twitter poll where I was like, "Oh, have you guys ever bought a stock because of me?" I think like 60% of respondents were like, "Yes." Scary.
Damn.
I don't love that. As always, everybody do your own research. You should use content creators like us as sort of like idea generation. Like, oh, that looks interesting. Let me go look deeper. You should use us for ideas, not the thesis. Do you know what I mean? Like, I don't know.
Yeah, all we know, guys, is we know nothing. So do your own research, and we're just here to have fun and talk about things we like to do and talk about our hobby. But
I
yeah, please
agree.
do your own research.
I agree.
It's your money, it's not our money. So please do your own research.
Yeah.
There's something
Adobe's
that
just
Ronnie says frequently that what does he say? He said something like, "You guys can't borrow conviction, because if you're going to borrow conviction, it'll catch up to you eventually." And I agree with that entirely.
100%.
Yeah.
100%. This goes back to what I was saying just a second ago of like your conviction will get tested when the stock goes down. If you don't understand the business, if it goes down 30, 40%, then you might think of like panic selling, and that might be the wrong thing to do. Adobe is just like PayPal, brain dead management team that are rent seekers, competition swarming, and no new products. Austin, again, I would encourage you to watch the Adobe Max. It is long, so I don't know, maybe there's like a cut up version of it, but I don't know. I feel like they're launching a lot of new products and features within their ecosystem there. So yeah, Adobe products are way too easy to pirate. There's a quote where the Microsoft founder Bill Gates, he talked about, like, he might have said this, I don't know, in like the early 2000s, when he was asked about like pirating Microsoft software, and then he basically said, he's like, as long as they're pirating our software, because that means that eventually, if they decide to go into those markets, or eventually if those revenues come to them, that's essentially reinforcing the moat. So obviously you'd want to have a business with no pirating, but that's going to happen regardless of what you want as a business, as long as they're pirating your software, because that just reinforces the moat and the standard moat of an Adobe, a Microsoft, etc. I caught this interview. I want to kind of clip it up and make a thread on Twitter. Maybe I'll do this after the stream. Uber customer experience. I asked my work group if people prefer Uber or Dash for deliveries, and 100% said it's Dash. It depends on the market. So in America, yeah, DoorDash is a 70% market holder. Here in Canada, Nick, you can attest to this. Like, has anyone in your circle ever used anything other than Uber Eats? It is by far the de facto standard. Like, I haven't heard of anybody using DoorDash, or we have another one called Skip the Dishes. Same thing for Australia, by the way.
Goofy Canadian name I've ever.
It's called Skip the Dishes.
That's so funny.
But like, dude, like everybody just uses Uber here. Australia, again, same sort of dynamic. I think Australia is one of, if not the best market for Uber. It's only Uber and only Uber Eats. So it just depends on the markets. In America specifically, that's where DoorDash's main profit generator is. In fact, I think DoorDash is only in America, and then they have an acquisition of Deliveroo in the UK and Ireland area. They're in some of the Scandinavian countries as well, but that's about it. Uber was in Denmark 5 years ago or so, but the government made it illegal to do taxi service without being a certified taxi driver. I guess this is for safety reasons. Yeah, fair enough. Never underestimate German bureaucracy and regulations. Yeah, definitely. Are you guys interested?
That's a good point too, though. Like, there's a lot of, bureaucracy is crazy in Europe. Anyway, yeah, we don't talk about it.
I think it plays to Uber's advantage in a lot of cases, because in the markets where they're currently entrenched and there is a lot of regulation and bureaucracy, down to like, I keep using this example, but it's just one of the clearest examples. I was in Cabo, and the Ubers weren't allowed to come to the front of the hotel. They were only allowed to go to like the gate, which is like a 3-4 minute walk away from the front of the hotel. And same thing goes for like airports internationally. Like, you might notice there's like different lanes for Uber specifically. Yeah. So the business is highly, highly localized, and that plays to their advantage. If there's regulations and laws and local rules, as long as Uber's already in those markets, it is the incumbent. That plays to their advantage versus AVs or other players in the industry. Are you guys interested in Netflix?
Yeah, you know what? I'm tempted here. I think it can get cheaper, but long term, I think it's attractive. Right now, obviously, the only thing that's kind of holding me back is the amount of money they're going to be spending on this acquisition is ridiculous, right? It's a lot of money. I think long term it benefits the company for sure, but because that IP is just not going on sale ever again if they can pull off this acquisition. But yeah, I'm not too sure. I haven't put a lot of thought into it. I have other things on my mind right now, but
yeah, I think we're in a market where if Netflix was down where it's at now and everything else is up, then yes. But I think there's too many other opportunities out there to me. And so I'm not really interested in Netflix, to be honest.
I agree.
Yeah, I'm right with you there. Although I will disagree with you on the. Is my face cam lagging, by the way?
A little bit. Now it's lagging, but it wasn't before.
Okay. Well, here, you guys talk for a second while I try to fix this.
Yeah, I think for me, yeah, again, like there's so many names that are down, like too many to count. And so if we're at a point where like I think 2023, 2024, where like most of the market's up, and there was a couple names that are down 50, 60% for whatever random reason, like an acquisition that they're trying to do going down or going bad for them, and so it sells off, then Netflix become interesting. But when everything else is selling off the same, if not more, I don't know. I like the other risk rewards in the market more than Netflix, but I think long term there'll be like a Costco. There'll be a business that like everyone just uses, and it has a solid base for a long time to come.
I agree.
Um,
I agree. Nate, what are you watching right now? Like, what are your 1, 2, and 3 picks right now?
here's the thing. Here's where I'm also like I don't I do get a little weary. Is I'm just such a YouTube kid. I legitimately barely watch TV shows. Like I am on YouTube. I mean, God, 3-4 hours a day is probably good. I work from home, and so I always have it on a side monitor, like so it might be playing in the background. I'm not like intently watching it, but I only watch like specific shows occasionally. I'm barely on Netflix. I still pay for it because we watch some shows here and there. But again, there's no like I think I don't know who I was talking this about, but I have YouTube Premium, and like I would legitimately pay $40
You're
a month.
telling me.
Yeah, I would legitimately pay $40 a month for YouTube Premium, and I would get rid of everything else, like easily. Like if I had to choose between one platform, YouTube all day.
Did you sorry, did you interpret my question as like what are you watching on like YouTube and Netflix?
I thought you were saying like, what are you watching on Netflix?
No, like what are you watching?
I meant like in the market. You were talking about other
Oh
opportunities.
my God, I am okay. Sorry. That's actually hilarious. So right now, I mean, Meta, Zeta, Nvidia, Pagaya. I think Pagaya will be a little choppy. Those are my 4 big ones that I like. I mean, even Nebius, I just can't believe it's still at $95 or $90 a share, whatever it's at. So really, my entire portfolio is what I'm watching. Also, I'm honestly looking at Robinhood too. Robinhood and SoFi are both names that I'm like, I think they're getting SoFi is extremely undervalued. And Hood, I love Hood's value prop and the company themselves. So those are the other 2 names I'm looking at too.
You know, Palantir, give it like another.
Oh, dude, if it's like $90,
Yeah.
Dude, I'm saying like give it another like 30% drop. Like it probably becomes undervalued if they're growing that fast. Because at that point, if you want to look at it on price to sales basis or whatever, right? Like it's like probably around a 50 times price to sales, trailing, growing 70%, probably accelerating from that point on. I was talking to Arnie actually, the Palantir Bullets. You guys, I think you know him. I was talking to him a little bit about it, but like I don't know, dude. Like I don't know where the acceleration stops, but even if like they grow revenues at like 50% for the next handful of years, you still come out like outperforming the market, buying at 50 times sales, assuming you exit at like 20 times, which I think the business, they've demonstrated that they're an extremely high quality business. They probably deserve that premium as sort of like an exit multiple, call it 5 years out, if not higher. I mean, we have a proxy of that for like, for example, like a CrowdStrike, which generally trades at a premium with, like pretty solid growth numbers and whatnot. So give it another 30% drop. Like it's arguably undervalued at that price. And I've been, super critical of the valuation for years now.
Yeah, actually, interesting enough, I trimmed Palantir in January because I wanted to wait until the new tax year, I'm lucky. But yeah, I 100% agree that Palantir is the best SaaS name in the market by a wide margin, in my opinion. And so I do think that even if it comes down, I mean, even at like $100 a share, it's piquing my interest for sure. To get back in there, I know it hit like a high of 215 or something last year, or 205 after 1 earnings. $100 a share though, I mean, that puts it at what? It puts it at what's it at right now? It's $131 a share, so it will put it at like a $220 billion company. Growing 70%, they're going to be doing like $8 billion or $9 billion in revenue this year, I think.
No, there's no way.
They're not $7 billion in revenue?
Billion? Really?
Yeah. I think so. Let me look. Because they just did 1 billion in revenue this quarter. 1.2 billion in revenue?
Well, yeah, I guess is that what they guided for? Wow. Do you know what they guided for in terms of growth? Like, is it 50% growth for the...
Oh, it's like 60 or 70% growth.
Jesus Christ. Dude.
I'm telling you, it's the best company in the market.
I think it was 7. Wasn't it 70%?
I think it's 70. Yeah, I think it's 70, and I just don't see it really slowing down.
Yeah, they just reported a 70% quarter, and I don't know what they guided for.
I mean, their trailing 12 month is $4 billion, so they're going to be doing $7 billion this year,
Oh my
$7.5
God.
billion.
That is, yeah, no, that's really fast growth, man.
Hey guys, did you
Yeah.
did you guys know that Zeta Global has really high stock-based compensation?
So, but
Yeah,
the thing is,
no.
my friend, you have to look at like the trend of it here, and they're ramping free cash flows while SBC is declining, and then at the same time they gave us, was it 3-year guidance where they're like it's going to be like 2 to 3% of total revenues. So this should either continue to decline or probably flatline from this point on.
Yeah.
You can also look at the stock-based comp adjusted free cash flow. Fiscal AI custom metric, by the way, link in the bio to give it a 2-week free trial. And so this is what that looks like. So this free cash flow minus SBC, they're basically at an inflection point. I would imagine, this quarter or the quarter after that at most, they probably flip to positive free cash flows and it just goes off from there, right? So, I think the trend here is a lot more important than what they've done historically, in my personal opinion. But yeah, no, you're right. They do have high stock-based comp, but the trend of it.
Yeah, I completely agree. And you know what? Nate has comments on this regarding SaaS and stock-based compensation. So I'm going to let him address that. But back to what you said, Arya, next year. So, I mean, they haven't reported Q4 yet, but once they report Q4, then we're fully in 2026 financial year. The management's quoting, I think it was 3 to 4% percentage of revenue, stock-based compensation, something like that. I don't remember the exact number, but ultimately that's down significantly from the 15% they did in 2025. So it's that stock-based compensation is pretty much going to go out the window very soon, just like Arya said.
Yeah, I think just to keep it short, I think if you invest in SaaS, you need to understand that SBC is just a part of the industry. It's a part of investing in SaaS. In order to have an innovative product in an innovative company, you need to have SBC to keep strong and smart engineers on your company. This is a big bear case that I faced for Palantir for like 4 years, and now no one says anything about it because they built a massive moat and built a product, and they're that innovative that now you see SBC as like it's the percentage of revenue is something ridiculous. It used to be like 200% in 2021 as a percentage of revenue, which was hilarious. But it's just a part of investing in SaaS, and people need to get with it. But on Palantir, they got it for 7.19 billion in revenue this year, and I guarantee they'll hit 7.5. They're gonna blow it out of the water, in my opinion.
Let's, if you don't mind, let's just do like maybe 3 more of these. Unless you guys are good to continue for a little bit longer, I do want to.
Whatever you want to do, man.
I don't want to take too much of your guys' time. But let's see,
Probably like
guys.
5.
We have a CEO in the chat. Real Alex Karp says, "Judge us differently than a typical enterprise software business." Dr. Karp, I'm a huge fan of your speeches and everything. I think you're one of the greatest founders of our generation. Yeah,
he's right. I mean, yeah, you're right, Alex Karp. You're right.
We got Amazon under 200 is insane. Maybe we could touch on this, dude. But Amazon is at its cheapest valuation over the past decade on a price to operating cash flow basis. Yeah.
Wow.
It's trading at like 14 times.
I just think like it's definitely a long-term play, but this is a company where all you need to do is literally not financial advice, but hold it and wait, because they haven't even focused on operational leverage. Like they've just been trying to grow and grow. They're going to be doing like $1 trillion in revenue in 2029, something like that, 2030. 1% of operating profit or net income profit, I guess, is $10 billion. So like all they have to do is move the needle just a little bit, really. And you see serious leverage. And I think they will be the the biggest beneficiary of the physical AI, and so robotics and that whole layer. Like I think they're the most obvious play in that realm. They're going to be a massive beneficiary of this AI move, and I don't understand the valuation, honestly. No. I get the worry in CapEx, I guess, and they're going free cash flow negative, and so that's the worry. But guys, like I don't know.
Well, I mean, what you didn't consider is Claude Code is going to vibe code, the entire business,
e-commerce platform, and everything else they have.
In all seriousness, though,
didn't think of that.
In all seriousness, we did talk about it a little bit earlier for people maybe just tuning in, but they guided for by 2033, they want to double the size of the e-commerce business without hiring more employees. That is purely driven by robotics. That's a huge amount of operating leverage that they're going to be able to exercise. Yeah, the stock is probably stupidly undervalued, although I think we have cleaner stories in SaaS and stuff like that at the moment. I feel like, all right, let's do one more. Okay, well, oh, Jesus Christ, it's like opening the can of worms. Nick, quick thoughts on regulatory.
Take a shot every time he says first party data. Go ahead.
Guys, they just like anybody watching this stream, these guys just don't want me to talk about Zeta. I don't get it. I don't get it. It's like I talk about it too much or something. I don't know.
Take your time. Take your time. I'm good to stay for a while, but take your time.
You know what? Like, yes. Does the opt-in portion of Zeta's data mode come into question regulatorily wise? Yes, I do think so. Eventually, you're going to see some pressure once they get to be big enough of a company, and they've already seen some pressure. It's inevitable, frankly. Anybody who's collecting first-party data is going to be in this position. You know, we see it all the time. Like right now, I think the European Union is pressing Meta for the exact same sort of thing. It's about first-party data practices, and there's concerns regarding that. It depends on what government you have in. Governments come and go all the time, so it's something you have to expect as an investor in this specific segment. If you're an investor in Amazon, if you're an investor in Apple, if you're an investor in Meta, Microsoft, you know, the list goes on and on and on. Google, for example, regulatory concerns will come up. So I don't view it any differently than one of those massive companies, frankly.
Yeah, fair enough. Fair take.
Keep it short and sweet.
Short and sweet. Love it. I think we lost Nate briefly. In that case, maybe we'll do like one or two more. I just want to have him back for the outro. I'd throw the house at Palantir if it drops below 85. I mean, I don't blame you. Nick, do you think they keep accelerating revenues? Like, where's the ceiling?
Yeah, I think I don't know, man. I don't know. I let's put it this way. I wouldn't bet on identifying a ceiling anytime soon. I think that this company is just going to keep accelerating. Like they're really bridging into commercial now because, Nate, correct me if I'm wrong, Palantir really founded its roots with the government first. And now more recently it's bridging into commercial, and it's just starting to do that. Like there's a construction company from my hometown, and they talked about this on the call. It's called like Kavanaugh Construction or something like this. And I thought that was amazing. I was like, whoa, wait a second. I'm listening to the earnings call and they're talking about this company. And I was like, this company locally just around me is utilizing Palantir. And they say 98% of their employees or something absurd like this utilize Palantir every single day. And without Palantir, they wouldn't be able to run their company. It's so interesting how that a company like Palantir can apply to, you know, not just these massive, huge corporations. Let's, you know, maybe GE or who knows what, right? But down to the level of like a local construction company utilizing this infrastructure. It's really cool. So I think the potential's really, you know, infinite in amongst Western countries for adoption of something like Palantir. I think you're going to see more and more of it as we get into this AI era and automation era too, right? People are going to need that type of infrastructure.
Yeah, I think I don't want to spend, you know, I could spend all day on Palantir. I've been a bull for 6 years. But yeah, like what Matic was saying, like they've only, as a company, they were government for 20 years. That's how they got all of their funding. That's how they built all of their moat. That's how they built all of their innovation. And then they went to commercial 6 years ago. Now the commercial is growing, just double checking. Their US revenue grew 93% year over year. The commercial grew 137% year over year. And so we're at no point, and I think 100% agree with Nick that we're not even close. I don't even think we're not even close to a ceiling for Palantir in terms of where they're going to go. Now, do they continue to accelerate to 80%, 90%, 100%? That's, you know, harder to say. I do think they will consistently grow 50 to 60% over the next 2 to 3 years as we're in an AI boom. And I think Austin put in the chat that if they grow 70% this year, which they're guiding for, and 50% the next years, they'll be at a price of sales of 15 in 2028. So, you know, when you look at it like that, like it sort of becomes, in my opinion, a relatively fair, if not undervalued company, depending on how you look at it. Yeah, I mean, they're doing, I was just taking a look. I think they have free cash flow margins of 41%, operating margins of 55%, and it's not slowing down. And it's not slowing down. Like they've just started becoming, they only became profitable 3 years ago. So like, what are we talking about here? They have so much longer to go, and their moat is so entrenched. Like even government wise, like obviously government revenue is more spotty. But I mean, you saw, I think
it's stickier.
it's way stickier. The army just I think they just signed for another
I
10
think it was the
years or
Navy.
something.
I believe it
Or
was
the
the Navy.
Navy. Yeah, one of the military branches signed for another like 10 years or another $1 billion just out of the blue. Like that was the bull case in Palantir is like a government could just come on and sign another 5 billion because they have so much money.
Mhm.
And the moat is there.
Yeah.
And so I would agree that like if it hit 85, I would genuinely probably make it a large part of my portfolio again.
Yeah.
I just thought at $175 a share, even $200 a share, it's too much for me at this point.
I'd bite at 85 personally. I'd have to run the numbers to be sure, but I'm pretty sure I'd bite under $100 somewhere around there. But I think the bull case for Palantir, and I've heard this before, is that if you fast forward 10 years, it becomes the standard operating system for your company, right? Just like
dude.
Windows, you open up a computer and you're running Windows at your average company. Any enterprise, for those who are watching the stream, and you're not in enterprise business or any sort of enterprise capacity, the running joke is that if you run your enterprise business off of Mac, that you're a shit business is going to hell. But it's all jokes aside. But ultimately, what I'm trying to get here is that Windows is that standard operating system, right? I think the bull case for Palantir is that one day that maybe perhaps they're that operational standard for enterprises across the world, and even just medium-sized businesses, perhaps.
That was, I mean, yeah, that's all it got. It's so funny here to talk about that. Like that was our little lonely little Palantir cult when we were $8 a share was like they're going to become the operating system of the world. And that was sort of exactly what you said is like, what if they do become a Windows and they're doing hundreds of billions of dollars a year? Like, I don't. To me, genuinely, I don't think it's out of the question. Now, obviously, there's a lot more they have to do. There's a lot farther they have to go, and we need to see a lot more growth to see that happen. But I do think their products are great, and I do think we're heading towards a world where like spreadsheets and Windows and the Windows products are going to be of the past, in my opinion. They're still helpful, they're still useful, but I think Palantir and the platform they're having is the next level of what we'll see with AI agents, the orchestration layer, on the ontology, which they always talk about, and sort of going that direction. But obviously, Windows, and it's hard for anyone to even fathom because Windows has been the operating system for the past 35, 40 years. So even saying that, you sound ludicrous, but it's not going to stay this way forever, in my opinion.
All right, bit of a last one. I kind of wanted to cover this when we were talking Netflix a little bit earlier. Nick, I kind of disagree with you in terms of they overpaid for the acquisition. I think they underpaid. And
well, I'm not saying that they overpaid. I'm just saying it's a large sum of capital. So as an investor, and I don't have shares in that company, it's something that I'm looking at. I'm like, is it the most attractive time to enter into this specific investment when they're about to make a huge capital expense? You know what I mean? I have to look into a little more detail.
What are they paying?
84 billion enterprise value. So I think it's like 70 something, for the actual company, but then you're taking over some of the debt. The way I run the math, like I don't look at the EBITDA or anything like that. The business itself that they're acquiring generates about 3 billion of free cash flow, but I'm purely looking at it from a perspective of like in basically year one, I would imagine they either bundle it or they cross-sell or give you a discount on HBO Max because they said they're going to keep the two brands separate. And I think if you do that, and by the way, HBO Max is in like, only like 10-ish markets, if I remember correct. Like it's not in Canada. Nate, I already told you this. Like we have Crave over here, right? But like it's not in these markets. I believe they've recently like expanded into like Germany and stuff like that. In January, I think HBO Max launched in Germany. You could double check me on that. I'm not 100% sure. But point is, Netflix, even if we assume every single HBO Max sub has a Netflix subscription, you have roughly 200 million people to play with that you can cross-sell over to HBO Max. Within basically year one, dude, like, you get like 20-25% of those people to, otherwise upgrade to a bundle or like, cross-sell it and get the standalone subscription. I don't know. But it basically works out with the cost synergies to like anywhere between $6 billion to like $10 billion of incremental free cash flow, basically within year one. Now, I don't think they actually end up doing that because, they're going to dump a bunch of money into content. And so that would kill the free cash flow. But like it has the potential to like make that much money. You know what I mean? So like the point I'm trying to make is you shouldn't look at what the business is generating right now standalone. You should be thinking about what the business would be worth in the hands of a Netflix. The same thing could go for like, when Trump was talking about like buying Greenland, Like, yeah, Greenland in of itself, like, it's not a bit of a weird, like, far-fetched analogy, but like, yeah, Greenland standalone GDP is not doing that well. But like, because of all the minerals and resources inside of Greenland, it makes it a worthwhile quote unquote acquisition for the US. Do you know what I mean?
Yeah, that makes sense.
I agree with you. I agree with that take. I like it. But question is, like, has Netflix provided any color about what they're going to do with HBO? If they did integrate them, are they going to keep it as a standalone product, or are they going to fully integrate that IP into their ecosystem? Just
So
as
they directly said that they would keep the HBO Max or the HBO brand because it's a strong brand, and I completely agree. It's known for premium quality TV. What I can imagine is they keep all the IP there, but like, for example, like, there's a new Game of Thrones spin-off show. They maybe put the spin-off show on Netflix for, like, while it's like airing, and then afterwards they move it to HBO. And so that way they kind of, like, I think this is what they're probably going to do. They kind of like expose the Netflix user base to HBO content and allows them to like be able to kind of cross sell them. And then another working theory I have is they'll kind of do the bundle modes, or like the bundle thing that Disney has done with like Hulu and stuff, but this time they're keeping it separate, right? So obviously Hulu is integrated into Disney Plus, but if they're keeping HBO and Netflix as separate apps, separate websites, maybe they'll give you a discount for like year one, year two, and then all of a sudden, again, like similar to the password crackdown, like they just like get rid of it, and they're like, oh well, you know what? You want to watch HBO content? You're watching Is Harry Potter on it? I don't know. You're watching like the Marvel, not the Marvel, the DC movies and the Game of Thrones movies and stuff like that. If you want to continue watching them now that you're hooked onto the shows after a couple years, you have to pay the full price. No more discount.
that makes sense. I'm not opposed to Netflix at all. I just similar to what Nate said. I think there's better opportunities right now out there.
Yeah, for sure. Anyways, guys,
ask me what I'm watching. Sorry.
What are you watching? What are you watching?
Oh my god, dude!
I gotta clip that up, put it on Twitter. So funny.
Dang it, man.
Getting clip, man.
I thought you were legit just like, oh, what are you watching, man? I was like, oh, this guy's interested in me. Let me talk about it.
Well,
you idiot, you stopped your buying.
I appreciate it. I learned something about you. I like that. I like that.
Oh
All right, gentlemen. I think it's a good time to wrap it up. Thank you to again for joining me here. Their ads are on the screen. It's also linked in the description. Nate, on top of his Twitter, has a YouTube channel. He posts a lot of content. Nebius, I believe you frequently cover. Hims, you've extensively covered as well. A bunch of different stocks on that front. Nick, on the other hand, he also has a Substack, done a bunch of write-ups on Zeta. Mr. Zeta himself, if you want to go check out his content. Nick, I believe you're doing another write-up on Zeta as well. Should be coming out soon.
Yeah, I am. So I've been working on this one for quite some time because Zeta fundamentally has changed over the last 12 months since I wrote my last one. Well, a little less than that, but fundamentally the company's changed significantly. So I wanted to get that on paper to try to explain to people, okay, hey, what does this company do, and break it down. But I wanted to wait until after earnings. So I have some forward-looking numbers that make a lot more sense. So yeah, expect that very soon, probably within the next week or two after earnings.
Yeah. Again, the link for both their Twitters in the description, and you can find the Substack and YouTube from there, because I think you both have it linked in your bio, right? Yeah. Okay.
Correct.
Great. All right, gentlemen. Thank you for joining me, and thank you for everybody for tuning in.